Yeah, everyone. I hope you all well. Welcome to our live stream. This is the Asian session. We're analyzing gold. So, with what I'm looking at right now, um, I'm interested in gold coming back to this area right there. But since it's dropping, I think this is just going to be a a missed trade opportunity. I wanted to place a sell just right there. But since gold has, I wanted to place a sell just right there. But since gold has decided to reject from this other block going down, I don't know, maybe it can come back and trade to this shaded area where I can place a sell. That's my area of interest for a sell. Then my stop loss will be just above this candlestick. Yeah, that's the idea right now on this Asian session. But now let me just analyze for the upcoming sessions, that the London session and also the New York session. So with that, we will have to use the bigger time frame. So this is what we have currently. Um, this is what we have. We have a fair value gap here. This is the fair value gap from this low, from this highs, this candle's high to this candle's low. Price was only offered to the buy side. There were no sellers. So that's an inefficiently traded price zone. So if price were to come down, or if I would enter or have an opportunity to enter a sell, I would be looking for gold to come to these regions. So this is a weekly time frame, which means that whatever trade that I'll be holding will be a long-term trade. So, but now let us go to the daily time frame. On the daily time frame, we have what? We see a low. So this is the low, right? So now we've got two things. We've got a low. Below the low, we've got what? A fair value gap. We've got a low there. Below the low, there is a fair value gap. So this is the weekly fair value gap, and this is the daily low. So this is draw on liquidity. The market can be drawn to these lows right there. Because of this low here, there's sell side liquidity there. And here there is a sell a fair value gap, a BC. A BC according to ICT. Yes, that's our mentor. So we've got a BC, which means buy side in. Actually, I've forgotten the meaning of a BC, but I know what it is. Um, yeah. So let us not get into it for now. I just know the abbreviation. So let us just, okay. Let's not put in the test. It's fine. Okay, let us just do it anyways. This is what we have. Or let's just do this. Sorry, then weekly FVG, which means weekly fair value gap. Plus we've got let me just also uh, do this. It's too big. Um, yeah, so currently this is what we have. We have sell side liquidity and the fair value gap. So this is draw on liquidity. This is draw on liquidity. So if I take a trade there, for an example, if I get an opportunity during the London session or the New York session to sell there, these are the areas that I'm looking to take out my profit, because the market would have done a lot of damage, or the market would have traded to its desired um, position, because now it would have now taken out liquidity and traded to a fair value gap. From then, I would not be able to predict where the market's going to go next. It's possible that the market can just close in the fair value gap, the weekly fair value gap, and continue going to the downside. But there are chances that the market can just take out the liquidity, trade to a fair value gap, or even trade to 50% of the fair value gap, then start going to the upside, which will be resuming its trend. So you see, there's this low and there is that low. This is a low liquidity um, resistant setup, because this low was not taken out, nor was these lows taken out. So it will make the market, or it's going to be easier for gold to come to trade to these lows, since this low was not taken out, this low was not taken out, and this low was not taken out. So they are clean lows in here. So there's a lot of liquidity that the market can run to. So that is the analysis for the remainder of the week. This might be taken out by Friday or not taken out at all. You will never know. And analysis is just a an idea of how you see the market. So when it pans out the way you would want to see it pan out according to your understanding, then that's when you start putting on trades. That's when you start preparing to take trades. Okay. So now I'll wait for the market to come back here. If I get a sell signal, I'm holding until these lows. But because the market has a language to communicate to each and every trader, using different methods of trading, there is no guarantee that I will, if I sell there, I will hold until the market gets to these lows. No, maybe the market might give me a reversal signal once it hits these lows, but preferably I would want to see the market taking out this low, trading to this fair value gap. Then that's when I'll consider buying the market. So that's all. That's the bigger picture for now. As you can see, this is the weekly fair value gap. You see, and this is the daily low, daily low, daily low with the fair value gap. So let us go to the 4 hours. On the 4 hours, we still see the same thing. Let's go to the 15 minutes. No, no. Yeah, I wasn't able to enter any trade. But this was my area of interest. So this would be my other prop, right there. So now, for now, um, since the market has denied me an opportunity to enter, let me just do this. I will place um, place a pending order just right there. There we are. Now let us just look at the account. The account is $10,000. So now let us just uh, use this as a funded account challenge. You see, so we want to make $1,000 so that we can pass the pro firm. Let us just treat it that way. Okay, we have a minimum loss of a daily drawdown of $5,000. So let's just do this. We're gonna use a lot size of 0.5. Now we're gonna delete. Let's delete this one. Okay, it's coming. We can do market execution. Let it get there. Once it gets there, we sell. Then stop loss. Stop loss is just right there. Take profit. Let's say take profit will be just right there. This will be take profit. This will be take profit. So now I think I don't have anything to say. Yeah, I don't have anything else to say since I have taken a trade on gold. Um, the analysis is that, as I said, selling here, we take the profit here. So now when we say take profit, when I say take profit, my idea on take profit is that once the market hits that desired price point for a take profits, that is the time when all trades are closed. But during a time when the market approaches your take profit, you should be taking partials, taking out partials, small profits, until your take profit is hit. Because sometimes it might not even get there. Maybe it might just reach halfway through. That is what we call trade management. Okay. So yeah, I think So there's equal highs, equal lows here. There's equal lows. For me, this is very interesting for drawn liquidity. Very interesting for draw on liquidity. So my area of interest was this right there. That was my area of interest. Let us watch. Oh. Let me just put in my tool for risk management. Where is our trade? Okay, let's just do this. So outside the created range from this low to this high. Now this would be 1:1, 1:2, 1:3, 1:4, 1:5, 1:6, 1:7. So the take profit is almost 1:7. $1,200. We're risking 170 dollars. So let us just watch and see how the market reacts. Our prices, sorry, it's going back and forth. Let me just go to the 1 hour time frame just to see what is happening. Um, let's go to the 30 minutes. Let's go to the 15. I'm using an MT4, MT5 platform. What's happening? Actually, I'm trying to grab my Fibonacci. Once price trades outside this range, once it trades and closes outside this line here, I will be taking my stop loss to break even, because at that time it will hit my 1:1 risk to return ratio. Let me check if I'm not mistaken. Yes, yes, it will hit my 1:1 risk to return ratio. Just when it trades outside that, I'm taking the stop loss to break even. But since the New York session and the London session are both closed, uh, the volatility is just something else. There's lack of volatility because both sessions are closed. Yeah, once it hits the 1:1 risk to return ratio, because I don't want to see it coming back to this area here, but there's a possibility that it might come back to this area. Once it hits this, my risk to return ratio, my 1:1 risk to return ratio, once it hits it, I'm taking my stop loss to break even. I'm securing, or, oh, sorry, risk to return ratio. Where are you? Okay, this is where I put the trade. So I just wanted to get there. Once it hits it, I am moving my stop loss to break even, or maybe to at least $5. Uh, just for to account for the commission as well, because if it's zero on the position side, on the commission side, they will charge me as well. They might charge me $6, so that's a loss. So maybe a $20 profit. Once it hits it, just right there, I am moving my stop loss. Yes. Yeah. Since it's and this also accounts for liquidity, right? So there's a slight chance that the market might come back and take me out. But since I've placed a trade, um, yeah, I think for now, we're just targeting these lows. So this will end my live stream because it's 4 o'clock in the morning. I need to sleep. There's a lot of liquidity just right there. So let's just further adjust our, at least to $30. We are targeting $1,000. So let us just want to see now what I would have wanted to see did not happen. That's why I'm not confident with this. I really am not confident with this. But then I'm just gonna, I think I'm safe there. At least a little bit of profit. So yeah, this will end my live stream for the Asian session. I've reached my objective. Um, the 1:1 risk to return ratio. I don't need to watch price anymore, because price can do what it does best. It can come back, take me out there, and just drop. We'll never know. Yeah, but for the Asian session, I just want gold to approach these lows. But since the Asian session is not that volatile, price might consolidate. It might come back to this region there and just, and does what it does best, which is taking people out of their positions like myself. And since it has traded out of the, look, this is what I'm talking about. Since it has also traded to these lows, there's a lot of liquidity there. That has the potential on its own. All of this price action happening here has the potential to take price to the upside. Maybe this whole move is just for price to take out the liquidity. But I am targeting these lows first. Let's just do this. 1,400. I'm targeting those lows. Let me just do this. I'll come back during the London session. If I'm taken out, I'll be looking to enter another sell. I'm not going to force the sell though. If there is a sell, I'll sell. But if there is no sell, I won't sell. So that's it. If there is a sell, I will sell. If there is no sell, I won't sell. So the market, all of this liquidity might send the market back inside the range where it would just take. That's another possibility. But I just like the fact that it reacted to my exactly at the region where I wanted to sell, it sold. So I'm satisfied with that. Um, all of this move that I'm expecting to unfold here can be an idea of the New York session or the London session, or both of them. Or it might happen or it might not happen at all. Maybe the market can just reverse just right here and continue going on the upside. But my analysis is that we are going down there. If we don't, it is fine. So yeah, catch you on my next video on gold analysis.